welcome to another episode of Beat Volatility with Mutual Funds by Outlook Money in association with Aditya Birla Sun Life Mutual Funds. When markets are volatile and sentiment is fragile, investors generally struggle to decode what volatility in market means. To help us understand this behavior, we are joined by Shailendra Dixit, Zonal Manager, Investor Education and Distribution Management at Aditya Birla Sun Life Mutual Fund. Thank you for joining us today.
Thank you.
Let's start at the very foundation. We keep hearing the word volatility on news stickers, in papers, on social media, and most people really don't know what it actually means. So, for the benefit of our audience, can you explain in very basic terms what market volatility actually means?
Volatility is a much used term. We get to hear it every day. And that is really the risk in equity. When you think of the market risk, the risk really is the volatility. So volatility for market, or for that matter any other feature that you speak of, or any other business that you will speak of, it is the change in experience on a specific period. That period might be second to second or month to month. For a given period of time, the change in direction and the change in amplitude is volatility. So your fund or your holdings or your portfolio gave X percentage returns yesterday. Today it is X plus Y, it is volatile. It is X minus Y, it is volatile. If the returns say the same day after day, it's not volatility. So generally people think volatility is only fall in the market. It's not the case. The returns going up much more than yesterday, or the market changing direction the next day, is volatility. In this, the duration of observation matters a lot. So if you are observing any parameter, say on a monthly basis, it might not change much. On a yearly basis, you will not find any volatility. The thing is that volatility is a derivative of liquidity. So because markets are so liquid, rather any asset class which is liquid will have volatility. The two most liquid asset classes are gold and equity. Surely gold is more liquid than equity also. So because you can observe the value literally on a second to second basis, it will keep on changing. This change and amplitude of change and direction of change is what we say as volatility. But we have to take into consideration the observation period also.
Okay.
So volatility will be different for a different person. It's in a philosophical basis, it depends on the observer, what is the volatility. Surely the time period that you take for observing any asset class will determine the volatility of that asset class. So liquidity leads to change in valuation, leads to change in direction. Surely the change in direction is for the simple reason that is the demand-supply mismatch that would happen. When the demand is high, the prices would go up. When the demand falls and the selling pressure increases, the direction would reverse. So that is the main reason for volatility, and that is what volatility is all about.
Okay. So one of the reasons you've spoken, what are the other causes of volatility in the markets?
Yeah, as I said, first is because there is liquidity, it leads to volatility. That's a very simple thing. The question is, why does volatility arise? And we come to markets because we want to surely have the growth or have the returns. We have to keep in mind that the fundamentals drive the returns in long term. So what the fundamentals are, say something like growth rate, your top line, your bottom line, the revenues, profitability, XYZ, are your fundamentals. Now those would feature once in a quarter. So once in 90 days, those parameters would feature or the results would come out. What about the rest 89 days? So rest 89 days would be based on the expectation of those numbers. Now that keeps on changing on a day-to-day basis based on the news, based on the sentiment, or based on any event that happens on that particular moment. Now that leads to the change in this demand supply of that particular asset class during that observation period. So what we have to keep in mind is, over the long term, the fundamentals drive the growth or the valuation. As I said, growth, profitability, stuff like that is a constant. That would lead to the growth in the long term, medium term. But on a day-to-day basis, that is not going to reflect. Day-to-day basis, it would be the sentiment of the market, expectations of the market, or anything that affects that particular stock or asset class on a daily basis leads to that change in demand supply and leads to volatility. So volatility is a variable, or to use the Hindi word agantuk. It just comes unannounced. It's not something which is expected. If it is expected, the market will not react in a volatile way to that. Constants are expected that it will be released on that particular day, and there are expectations that you have set in for that. Now they might match or not match, and accordingly the stock will change. For instance, if you had a stock market where trading happens only on one day, that is first of every quarter, that is the only day stocks will be traded, you might not see that sort of volatility because the results are out and now you know whether you want to buy or sell the stock. So there will be only two numbers and the volatility will not be there. But because you are trading every day in, day out, every second you are trading that particular asset class, and in between those variables keep on happening every day or the other. You know, some statement is made by some political leader somewhere, something happens in some corner of the world, affects you. So all those things lead to changing in expectation of the results that we're going to see down the line for that quarter or for that year or for that decade also for that matter. And that is what leads to volatility. So these variables are n number. They might be local, they might be global, they might be based on commodities, they might be based on politics, geopolitics. So many factors are there, and hence we call it the variable. It will come and go. So the variable comes, it goes, it creates volatility. It is the constants that bring the market back on track and create growth for you in the long term. Mostly, what does feature in news? Is it the constants or the variables?
It's always the variables.
It's always the variables. So because the variables are hammered so much on a daily basis on the investor or the audience for that matter, that leads to the volatility. If constants are hammered daily, you will not see that sort of volatility. But then that would be very boring also. So we keep on seeing the variables coming up every day. And that's what leads to volatility.
That's a very clear explanation. Okay, once volatility actually shows up, we've all seen how people start reacting suddenly, you know. So from your experience, how does volatility typically impacts the behavior of mutual fund investors?
So there are two kinds of investors. One are experienced investors and one are new investors. New investors would either come directly or they would come, you know, with the help of an advisor. There's someone to guide them. In any case, whether or not there is someone to guide them or someone who is new into the market with or without the advisor's help, he is coming into the market with a certain expectation. And he is coming to the market looking at a certain return that have already set in. So the main driver for his decision to invest in the markets is momentum. Or in simple terms, you can say inertia. Now, what is the law of inertia? Newton's law of inertia. You will have to go to second or fourth standard. Anything that is set in motion or steadiness will continue to be steady or in motion till acted by an equal and opposing force. Now, this is a law of physics, not of finance. In finance, that is not the case. So, investors typically enter looking at momentum. So, if the market is having momentum, we see more and more people coming in with the expectation that this momentum or this inertia is going to carry on. Even if they expect it to reduce, they don't expect a significant reduction in that momentum or direction of the market. Mostly they will expect it to go up only. So they come up, they enter the market with that expectation or that inertia. As the journey begins, they see that that is not the case. And that is when the panic sets in. That the expectation which was in mind, they are not experiencing that in the medium term. What is medium term? Say 1 to 3 years. Short term is say 3 to 6 months. So 3 to 6 months they will say, okay, theek, you know, I am ready to give some time. But if in the medium term also the expectation that they had in mind is not turning up, and as I said, some variable gets activated.
Yeah.
And rather than having that expectation set in, the actuality is reverse of that. Over there, the investor really panics. The expectation which he got into this, forget it being in that, slightly lesser than that, it's not even in that direction, it's a reverse direction of that. And on the lighter note, you know, that happens in personal life also. Marriage is a classic example of that.
Yes.
So that's why most people say, no, arranged marriage is fair enough because you go with basic expectations. Jo bhi hoga, usse acha hoga. And surely I'll not comment on love marriages because of that. But the expectations that you have before getting into any sort of a relation, that's the relation with your investments in mutual fund, in the medium short term, it doesn't turn out to be that way. And when it turns sour, they tend to feel that this is not going to reverse. And that's where the panic sets in, or that's where the discomfort or the disenchantment sets in. Just like in personal life, if you go through the bad patch, eventually end mein sab kuch theek ho jata hai. But it's important for you to go through that bad patch of the life. May it be your career, may it be your personal relationships, or may it be your investments also. there will be those bad patches. If you have the strength to stay in that relationship, because there will be good and bad days in any relationship. If you can stay in the bad days, you will surely enjoy the good days. That's why we say the friends who stay with you in the bad days are your real friends. So the same is the case over here. If you can stay in those tough days, and what are the tough days? When the returns are not as per your expectations or there are losses. If that mentality is there, he will not suffer. But he is entering in a euphoria. And if the advisor can guide him, this euphoria is maybe right now, it may or may not continue in the future, he will not have that a bad experience. So I think that's where a lot of difference is there between an existing investor who has seen the cycles of market and a new investor who is entering, seeing only the good days. I'm sure you know the term for people who enter during the good days. The investors are known as, the Mahabharata reference is Abhimanyu investors. They know how to enter. They're very excited about all the things, but they don't know about the exit part of it.
That's very interesting. A lot of it is kind of an emotional decision for
It's an emotional
investors.
decision. It's an emotional decision.
Which brings me to something that we observe often, even when nothing has changed in the economy or fundamentals, investors still kind of panic at the, first sign of a market fall.
Market fall. Yeah.
Okay. So why do investors panic so much when markets fall suddenly, even if the fundamentals haven't changed actually?
Actually, we discussed that initially only, that the fundamentals are not told on a daily basis. And the variable is told on a daily basis, and it's screamed from the rooftops. You feel it's the end of the day, end of the world. And then you just want to relieve whatever little bit is left with you. Frankly, it's not little bit, it's really good amount is still with you. But over here, the prospect theory really is very important. I'm sure it's a Nobel winning theory. Everyone knows about prospect theory. That the amount of joy that you get out of gains, say a quantum of joy, say you're expecting 10% returns, you got 15. Say you got 1 kg of joy. But instead you get 1% loss, you get 1 ton of pain. So that, again, as you said, the emotional part of it, the feeling of loss is so high compared to the feeling of gain. That's what the people don't want. I mean, I say, like in your otherwise life also, you don't want pain. You want to have a good experience. If not a good experience, a plain vanilla experience. This pain is what people don't want to go through. They feel that they are already seeing the pain of a certain loss. If it continues more, that pain is only going to aggravate, and that's where they panic. So it is again on the emotional point that losses lead to pain in the mind of the investor. That makes him panic. You're very right when you say that investing is an emotional decision. Frankly, 99%, I won't say 99, that will be quantifying, a bulk of investors are emotional when they're taking any decision. Surely it comes to investments also. And because now that emotion triggers in them of loss, the panic happens. If someone reassures them that this is a short-term phenomenon and the good days or the returns will improve over a period of time, that can calm them for a certain period of time. Again, someone who has seen the cycles of market will not react this way. For someone who has seen the subprime crisis, would not panic so much during demonetization. For someone who has seen demonetization, would not panic so much during COVID. And for someone who has seen COVID, would not have panicked so much during the Ukraine war. So once you have seen the good and the bad cycle, and you know that that's how life goes on also in cycles, once you have seen the good and bad cycles, then you will not panic. But for someone who has not seen this cycle, has not experienced it, the panic will set in. The fear of pain. Actually, panic includes pain in that. So it's a word play, but pain is a part of panic.
So, panic often leads to very quick decisions
Very quick decisions.
Wrong ones.
Wrong ones.
Also. So, can you explain us the risks for investors? Let me just do it, sorry, again. Panic, obviously leads to very quick decisions and often very wrong ones. So, let me ask you this. What are the risks for investors to react to short-term market swings instead of focusing on their long-term goals?
Yeah. The thing is, I said, it's the expectations that they had. Now, for example, to give an analogy, that we have created a financial plan for someone based on some calculations that, you do a 10,000 rupee SIP, so you get a 14% return, your money will double in 10 years. Your investment is 1.2 lakhs a year, 12 lakhs for 10 years. And say 13% returns, you will get around 23.4, 24 lakhs. Roughly, that is your expectation. A year or two down the line, the markets are not delivering the sort of returns. and you have invested 2.4 lakhs, say in 2 years, and you're currently sitting on maybe less than that, say on a 2 lakh, you're sitting on a loss. Now, over here, I would go to the very root cause of it is financial literacy, that is missing. Apart from that, it is the fear of maths. Like if you randomly ask, you don't have too many people here, but if I had a crowd of say 100 and I ask them which was the subject you feared the most in school, what would be the answer mostly?
Yeah,
It would be
related
maths.
maths or economics. Or
Mostly people say it's maths, you know. People say when they fear, they still feared math. It's not they disliked, they just feared maths. So the calculation part of it is something that people don't understand. The fear of math is so high that the simple calculation that we discussed right now, it doesn't strike them. So the very root cause is the way math is taught. Although we are deviating from the topic, but you know, my father always told me the subject is never boring, the teacher is always boring.
yeah.
So the way math is taught in school, the understanding of basic mathematics somehow is missed out. That fear from second or fourth standard carries on throughout your life. That's why we see many people saying, "आप बोल रहे हैं ना, ठीक है." They will believe whatever you are saying. इतना पैसा मिल जाएगा. So they are perfectly fine with whatever you are saying, because they don't want to go into the details of math or whatever the calculator says. They are saying, "Okay, the calci is showing, it's perfectly fine." Fear of maths somehow eventually where it metamorphosizes is over here in taking the wrong decisions. That this loss which is now is temporary. When the markets come up, this loss will be covered up and you will make gains. But somehow that understanding of math is not there. And because of that root cause, people first of all fear investing. That is the first thing. Even if they invest, when they see losses, they can't mathematically calculate or because there's no visualization in maths. You know why maths is the most feared topic? No visualization. History, full of visualization. Biology, you can touch and feel. Chemistry, you actually play around with the chemicals. English, it's so much, you know, there's so much to languages as to say. There's so much of creativity or thinking is enabled. Nothing like that in maths. And kids love creativity and visualization, not so much on the. And what is maths? Set of rules. Just rules, not even logic. Rules. And that's why we don't like maths. It metamorphosizes into, taking the wrong decisions. What is the loss? Opportunity loss. What we were saying is, do your SIP. End of 10 years, you'll get 13%. In between, you might see losses. Eventually, your IRR. Now, that is a very complicated term, IRR. Eventually, your rate of returns will be 13, and this is the sort of returns which will be delivered to you. Inability to understand mathematics, according to me, is one of the main reasons, which is mostly ignored. That leads to the investor taking a wrong decision, not understanding the opportunity loss, and hence making an exit. And the potential what he would have earned, he is not able to earn. He goes to a safer option. Whatever returns he gets over there, he misses out on the opportunity. Like the instance what we discussed right now, your money would double, say, in a decade at, say, 13.5% returns. At a 7%, it would take maybe 15, 16 years. So, but he is okay, giving up that extra time and money, but he just wants to keep it safe.
That's actually a great explanation. Speaking of reactions from investors, whenever we see a pattern every time markets move sharply, what are the common mistakes that investors make during that time? And markets either move very quickly up or they fall sharply.
Yeah. The most common mistake is deviating from the goal. That is the first most common mistake. And that mistake happens because the goal setting has not been done properly. When you start investing, people look at the goal only.
Yeah.
But there are 3 steps before that. One is your risk profile. Second is the sensitivity or importance of that goal. Sensitivity in the sense, how important it is, how critical it is, I would say, of that goal. Third is the time period that you can give for it. For example, I want to go for a foreign trip, say 5 years down the line. I want to go to Switzerland or somewhere, that sort. I want to accumulate money for that. I do an investment, an SIP or a lump sum, whatever it is. I am planning to have 20 lakhs. Now, for whatever reasons, it turns out to be only, say, lesser than that. Not a life and death decision. You can still compensate for that. In the same money, you might not go to Switzerland. you might go to some other foreign destination, or you can put in some extra money and still achieve your goal. So that goal is not very critical. You can still patch up some way or the other. Critical goal is your retirement. You're planning for it. 15 years down the line, you're going to retire, and you're making some plans for that. It's a very, very critical goal, because after retirement, your income, the regular income from salary or business, is going to stop. Over there, you need to plan differently. The criticality is different, the planning is different. So these first 3 steps, if they are missed during the planning part, your risk profiling, the duration, and the criticality of goal, then the person would panic or make a wrong decision. Say for instance, the same 2 goals are there. 5 years down the line, after you made your retirement plan, the things are not going as per what you expected it to be after 5 years. That was your plan. You can still review and do something about your folio and make the necessary changes, and just ensure how you can reach your goal. You might have, maybe you'll have to add some more money if it is possible for you. Then you can try to patch up for it that way. But if you lose sight of the goal and you have not done this homework before entering into your financial planning, then you are clueless about, I'm just left in the lurch, in limbo state. And then you say, let me just get out of this uncertainty that I'm facing at this point of time, and you just make a wrong decision. So I think if these first 3 steps, they are done correctly, you spend a lot of time discussing the same thing, make your family a part of it, especially your spouse a part of it, then take a rational decision, look at all the possibilities that are happening, and then you make a plan with all the possible things that can happen and how you will deal with them at that point of time. I think then you will not make a wrong decision. I think those first 3 steps, if they are done correctly, and rather than looking at just the goal, then I think then you're set.
Yeah, very practical approach to life. Another thing that investors actually do, they start chasing last year's return on a fund. So I want to understand this better. Why is it harmful when the investors actually chase recent high returns in rising markets, and then they kind of, follow it up and they're like, now I'm set. Kind of, it's still going to give me the same kind of returns like it did last year.
I mean, the reason why, you, me, or so many from the investment industry are here is because of the recency bias that investors show, kind of, usi pe hamara ghar chalta hai. If that was not the case, a lot of things would be at stake otherwise. But yeah, that is a natural tendency. Again, it's a human behavior will not be different in different places. A person who is very cautious in real life would be very cautious in investments also. A person who is a risk taker in personal life would be a risk taker in investments also. For an example, if you go to a restaurant, you have in mind, now I am from the western part, so I know pav bhaji. Over here in Delhi, it might be chole bhature or something, which is a very common dish. You've planned that I'm going to go to this restaurant, I'm going to have this chole bhature or pav bhaji. When you left your house, you're thinking of that. When you parked your car, you're thinking of that. When you went into the restaurant, you're thinking of that. When you sat on the table, you're thinking of that. Before ordering, a sizzler goes past by you. Now, sizzler क्या होता है? सारी इंद्रियां जागृत कर देता है. Sizzler is the only food which can do that. It makes a lot of noise. No other food makes noise. So it has smell and noise, and surely you're tempted. And what is that? And then you say, forget the pav bhaji or chole. I'm going to have a sizzler. So what did you do? What influenced you at that point of time made you change your long-term decision? What you were deciding since yesterday or today, you changed it at that very instance. Something happened then, and you changed your decision. Only after having the sizzler, you may or may not like it.
That's true.
That's the risk you're taking.
Yeah.
Same happens here also. And that is a classic case of recency bias. So people who are subject to this risk in their personal life will be subject to their risk in investments also. It's a very natural tendency. It will happen anywhere. If you go to an unknown city and you just want to have a meal somewhere, you will see 3-4 restaurants are in line, and whichever restaurant there's a lot of crowd, you will tend to go there because this crowd, this seems to be a good place, but might not be to your liking just because there is crowd going on there. So one thing is the herd mentality, that everyone is doing this, let me do the same thing. Whether it suits, as I said, your goal, your risk appetite, and the duration that you want to invest is not taken into consideration. Whatever everyone is doing, let me do the same thing. Again, he is investing just based on inertia. But that is our nature. Only when we make that mistake a couple of times, Again, I said, even in our relationships, also if you meet people who are very talking to you very sweetly, but they are not so good in personal life behind your back, you go through it twice or thrice, then you really know who are your genuine friends and you stay with them. So a new investor would tend to make that mistake that this fund which is doing really well, or this stock which is doing very well, or this asset class which is doing very well, or that category of fund which is doing very well, let me put my money into that and I'll get a good experience. It doesn't turn out to be that way. That is the price you pay for learning, because you have not learned the basics of stock market. Yeah. I think great investor has said that if you come into the stock market and you don't know it and you lose money, that is the money you paid for learning stock market. If you had gone to a college and learned it and tried everything, you would have paid some fees there. So market आपसे fees ले लेता है अगर आप सीखे नहीं. So investor who has not learned it, this is the price he pays, but he should not deter from re-entering the markets after having learned that thing. You make a mistake, what have you learned from that? You learn that and you make your next investment. So that is what first-time investors always tend to do. I have done that, I'm sure.
Yeah, very relatable.
Very relatable, first-time investor would not even want mutual fund, he would want FNO.
Yes.
He would say, this much long to make so much of money, let me put a fraction of that money into options and I'll make it in a day's time.
Exactly.
And yes, I'll try 10 times, even then I'll be putting a fraction of the original money. And maybe after the 11th time he says, no, mutual fund is good enough. So you learn it only by going the rough way if you're doing it yourself. Yes. Over here, a good advisor really helps you. Okay. So good advisor's role is that, managing an investor's behavior, not just his money.
Yeah, that makes so much sense. And the opposite behavior actually happens in corrections. People get scared and stop their SIPs exactly when the market is offering them a better entry point. Can you explain why stopping SIPs during market corrections can actually hurt your long-term goals?
Yeah. Can we play a small maths game?
Maths. See, fear of maths.
Fear of maths. Well, even then we'll try. It's very simple.
Yeah. Fine.
I have an SIP going on. The NAV is 30, the investment is 3,000. Okay. Markets fall, the NAV is 20. My SIP is 3,000. First month 30 NAV, next month 20 NAV. I have invested 6,000. I'm at a loss. Yes. I'm at a loss. Tell me what is my break-even NAV at which I will have no profit, no loss. Market has to recover, right? It has to come back from 20 to a new NAV level. Only then I'll be at a no profit, no loss. At least my pain of loss is over. I'll continue with my SIP. One installment has gone at 30, one has gone at 20. What is my average?
25.
25? Over here, again I'm saying, it becomes the understanding of working of an SIP, which is really so day in, day out for us. Yeah. At 3,000, you get 100 units at 30 NAV. At 20, you'll get 150 units, right? 3,000 divided by 20 is 150. Total units is 250. Yeah. Investment is 6,000. 6,000 divided by 250 is 24. It's not 25. Now, a lay person, not your mistake, in day-to-day life, we do plain averaging. Exactly. Adding of entities divided by number of entities is average. Right. Do we do rupee cost, what we did right now, ever in our day-to-day life? No. Never. Never, ever. Gadi ka average of your vegetables, whatever average price you are paying for milk, is all average, adding of entities divided by number of entities. In our day-to-day, daily life, never ever we do rupee cost averaging. We just saw live demo of that. Yes. We are in this business for such a long time. Yes. And whenever I have done this small thing, the answer has always been 25, not your mistake. So now this understanding is what is missing over there. Most people understand that when markets fall, I'll get more units, and when it recovers, I'll make more money. So people understand the compounding part very well, that it will come up. They forget this NAV is exponentially going down and going towards where the new NAV, that is 20. Next month, it will be 22.5. Most people would say 30 plus 20 plus 20 is 70, divided by 3 is 23.33. It is 22.5. The more units you buy, you are going closer and closer towards what? 20. So the more units you accumulate, who will make money much easier or who will come to profit much quicker is a person who continues his SIP during the bad times. Right. Now this understanding of simple math, again as I said, is never explained to the investor, not his mistake. SIP is such a rage now, 30,000 crores. Stock market has become Atmanirbhar because of that. Today the DI holding is more than FI holding. First time ever I have seen that happen in my experience, that DIs are holding more of our markets than FIs,
Right.
It's all courtesy SIP. The power of SIP is so huge. All those investors, bulk of those investors, I don't think understand this simple working. They just go through the simple understanding. When it falls, I get more units, and eventually, when it comes out, I'll make money. So that eventually is 3 years. In between what? Or say, if it has fallen the first year, it eventually will happen a few years down the line, not immediately. Intermittently, this is working for you. Your SIP turbo engine, or it goes in a turbo mode in a falling market. That is where that unit accumulation and eventual wealth creation is going to happen. SIP, because it is such a rage and it has become an OTC product, this very simple reason, rupee cost compounding are the two reasons why SIP creates wealth. Rupee cost is not understood so well. And like we see so many SIPs stop within 1 year. One of the main reasons is this, that the market has fallen and I'm seeing losses. Past 25, 28 years of Sensex SIP, forget a fund. Sensex SIP, say there are 300 instances in the past 25 years, every month one instance. Jan to Jan, Feb to Feb, March to March, every year 12, 25 years ka will be 300. Can you guess how many instances are negative? Roughly, just make a wild guess. Of this 300, how many number of instances were negative?
120.
It's about 98. It's about 1/3, 27%. So people would say probability is 27%. But again, the emotional aspect should be understood, or the behavioral aspect. When would you start your SIP? During the negative returns or during the positive returns? A person, when he says, I want to start a SIP, would it be when the 1 year is negative or when the 1 year is positive?
When the 1 year is positive.
1 year is positive. So he's in the other half. So the chance of him staying in that 73, 74% is say 36%. And the chance of him falling here is say 26%. It's a 40% roughly chance of you getting a 1 year return negative. That is what Sensex says for the past since 98, 99. Now that awareness is not with the investor. It has become an OTC product. What I told you, 10,000 rupee SIP, 13% returns, 24 lakhs. You feel that's it, great, this is what I'm going to get.
Yeah, right.
Intermittently, what is the journey? You're not told of. You're just told, I said the goal, the final result. Intermittently, what is going to happen is never experienced. It's never told, forget experienced. So because that is not told, his experience becomes bad. See, you're going from here to, I don't know, Parliament. If you don't have a Google map and there's a jam, you're going to be very frustrated, you're going to bang your head. But if you have a Google map, you're ready for that jam. Mentally, you're prepared. You know, there's going to be a jam and eventually I'm going to reach my place. It will take 40 minutes. If the jam has dissolved by the time you reach there, there's a wow. So this can happen, or this does happen, is not known in the short term. So what we have seen is people who stay in the SIP say for a decent period of time generally don't stop it. Unfortunately, most of the stoppages happen in the first couple of years. One is this, lack of understanding of rupee cost. Second is recency bias, what we discussed, what is doing well doesn't continue to do well. So, you know, these factors lead to SIP stoppages. If that is explained to him properly, he will not stop the SIP. And third, the cognitive understanding. I said math is, I won't say cognitive, it's too basic. But even when I'm saying your money will double or whatever XYZ is goal you're going to achieve in 10 years, at 7 years, this 10,000 rupee SIP investing 8.4 lakhs would be standing only at 13.5 lakhs. Now you can't visualize how can 13.5 become 24. It's almost doubling. And 70% of the time is over. You said, ho nahi sakta. And then you exit the SIP. I said, so these are very behavioral aspects for SIPs too.
Yeah.
You have to give the time. You have to give it its time. I mean, chalo, we'll amplify it in the later part.
I'll add to whatever you're saying. There's this habit with investors checking their portfolios very often, you know, which creates stress. Of course, they do not go into all these details and everything. And again, you know, so the frequently they check their performance and react accordingly.
Yeah.
So how does it actually help them?
Doesn't help. I mean, I was going to give the same example and incidentally you asked the same question. So good I did speak it beforehand. That's nice. Let's look at an analogy. I don't know. I mean, I'm not a very good cook, but I'm sure everyone knows how biryani is cooked, a dum biryani. I'm sure you also know.
Yeah.
If you cook a dum biryani, how do you know that it is ready? Is there a way to know it is ready? It's only by the smell, you know. Yeah. The aroma comes and you know that the biryani is ready because it's tight lid and you have put the atta and everything. So, do you open the lid again and again for the biryani? No. Now, if you ask the cook or the man or the woman in the house who's cooking, how much time it will take, he says maybe 60, 70 minutes. If you ask him on a stamp paper, right, he says, I can't guarantee, but it generally takes 60, 70 minutes. And he says, how do you know? When the aroma comes, I know that my biryani is ready, it's good to go now. My goal is achieved. You don't open the lid because the kacha biryani na kha sakte na phek sakte. Because over here, you have the liquidity and the facility to know your valuation every day, you're looking at it every day. This biryani also, just give it its time. When it reaches the goal, वो smell आ जाएगा, it has reached to that value what you wanted. Only then you pull out the money.
Yeah.
Don't open the lid again and again. It's not going to cook faster by looking at it. Your child doesn't go faster by looking at it. A tree doesn't go faster by looking at it. Your SIP is not going to go faster by looking at it. Rather, as I said, the experiences can be disheartening in the initial part. In COVID, a 5-year SIP went negative. The next year, it was back with a bang. The 6th year, as to say, for that SIP was fantastic. So the first couple of years can be disheartening. If you look at it, आपका तो मन गिर ही जाएगा. And you say, it is not possible to reach over there. When I've started with such a tough thing, it's like your travel. Say you go from Delhi to, I don't know, now there are highways everywhere, but say you go from Delhi to Agra. Getting from center till your toll, your speed will not be more than 30, 40. Only when you reach the expressway, you really have the high speed. And again, when you reach towards Agra, the speed will reduce. Your average speed is 80, whatever the speed might be. Same is the case with your SIP. Your first couple of initial years may or may not turn out to be very good. Just be ready for that. Statistically, we can discuss and debate, that's a different thing. Mentally be prepared. The first couple of years may or may not be as per the expectations, but we are in this for a long term. That is a 10-year, 15-year, 20-year thing. If you are mentally prepared for this, just like that map showing you the jam, and then the heavy opening, if you are mentally prepared for it, the problem will not be there. So when you are doing financial planning, SIP being a OTC, you just tell the calculation and finish. If you ask a person randomly, even an advisor or an investor, how long it took for you to decide the SIP, he would say 1 minute. If you have invested 1 minute, how do you expect the returns to be there? Really, what you are investing is not your money, you are investing your time. Those 10 years of time and the time for studying and making the decision before investing. You have to give your time. Like people always say, I have never lost money in real estate or buying a flat. My question is, how much time did you give to buy a flat? You would say 6 months. I went in the morning, I went in the night, I saw the community, I saw pani aata hai ki nahi, kamali bhai hai ki nahi, school is nearby. I checked hundreds of things. I checked for 6 months, I checked the builder, the loan, everything, and then I bought my flat. You will not go wrong. Here you bought just on a tip you heard somewhere or something you read or something you heard on the social media. For how long? 1 minute. You have not invested enough time in taking the decision, then one should not really question the outcome of that decision.
That's so true. Patience is the key.
Yeah.
Okay. Another pattern that you actually observe with investors is they think accumulating funds, there's more diversification in the portfolio. So, why is owning too many mutual funds not actually a good diversification strategy?
What is too many for someone is very different. It's really very, very subjective. You really can't say. Some people diversify just because they are basically good-mannered people. No other reason.
Okay.
It's just good manners. Someone approached them, someone who knew them in the distribution industry or from the AMC. That, sir or ma'am, this is a fund and why don't you invest? Just out of sheer good manners, they bought the fund. Believe me.
Because they don't know how to say no.
They don't know how to say no. Or they had the money and whatever the other person said, he said, Acha, this is okay, and he went with it. Sheer good manners. Now that is one reason I really would say, leave your good manners and diversification. But I'm saying surprisingly what we feel about investors and how they invest, we maybe from being the industry might always think, this is right and this is perfect and stuff like that. But for a lay person, or a common person, what is he basically doing? He is outsourcing his goal planning or managing his money. So many people don't invest with a goal. They just said, bahut paisa chahiye. I just want to make a lot of money. Any goal? No, I'll use the money whenever I want it. Because I don't need the money now. I have a lot of money. If I just keep it also, my future is taken care of. So I just want it to grow a lot. What will you do? I don't know. Will you pass on to the generation? Who knows? I mean, they might not want it. They're not in India also maybe. They're abroad. Fair enough. Perfectly fine. Diversification might be happening because of many reasons. One, I said, very surprising reason is just being good-hearted or good-mannered. Second is FOMO. Something is doing really well right now. Some sector or some fund is doing really well right now. I don't want to miss out on that. Again, the same thing, the recency bias. What is doing well right now? I have certain funds in my folio. This category I don't have. I want this flavor also. He diversifies. Next year, some different asset class starts working, say gold and silver. No one ever looked at gold and silver so seriously. Earlier, if you ask people, do you have gold in the folio? Wife or I have jewelry.
Exactly.
That's
in
it.
physical form.
I don't invest in digital gold or through mutual funds. Look at the rush now. So FOMO is second reason why people diversify so much. Can you stop it? It's a behavioral trait. How can you stop it? Very, very tough to stop a person's behavior which has been cultivated over decades of time. Third, a bad advisor. Simple. I mean, you didn't get a very good advisor and hence you diversified so much. What is going to happen is you'll just not be able to know from where you are getting what returns and what is the eventual. You're just looking at the eventual return you got. Now, some people are okay with that, having 10 large caps, 10 mid caps, whichever is the current fund, and their eventual return is up to their expectations. They are okay. Some people would really want to track, where the money is going, where it's going right, where it's going wrong. Should I remove this fund? Should I keep this fund? Then lesser quantum or lesser number of funds really matters to them. It's a bit like diet. Some people restrict their diet and very particular, this much carb, this much protein, and only this veg protein and that and that. Some people say, kuch bhi chalega. I'm just going to be fit. I just need to enjoy my food. So diversification, the risk is that you will not know which fund is not doing well, when to get in, when to get out. Is it a very critical risk? I would say not a very critical risk, but the risk is the overall experience might just get diluted. So really is a very case-to-case thing.
Actually, that brings us to a deeper issue as well, which is self-awareness. A lot of investors don't actually know what is their risk appetite.
True.
How does investing without considering one's risk profile lead to poor outcomes?
It can be disastrous. A person in 50s, we would say, should take lesser risk. A person in 30s is okay to take higher risks. And a person in 80s should not take equity, should not take much of equity at all. That is a general understanding. Look at the diverse part of it. A person in 80s, he is very well off and he says, this money I'm going to pass on to my next generation. So they will use it maybe after 10, 15 years, put it into equity. Perfectly fine. So 80-year-old can put a lot of money in equity if he doesn't need and his needs are taken care by whatever investments he has done. It's taken care of for the time to come. I hope he lives 100 years. So whatever is there is taken care, then he can make an equity allocation. A guy in 50s has taken a home loan very late in his life. Next 10 years, he's going to have a home loan also. Job is at a stake in case, the private job or something is at a stake and he is a single earning member of his family. Now, that person is actually a very high risk person to make an equity allocation. God forbid something goes wrong in the job, worst case, God doesn't do, but with him, the entire thing is going to go for a toss. If the job goes, that money will be needed to survive after that only, forget the retirement planning that he has done. So, not knowing your risk can lead to disaster for the investor if he is not aware of it. More than that, starting very late is the real biggest risk that you can have. So, your risk increases as you age. So, when you are younger, not always, but by and large, your risk is lesser. So, not understanding that the risk increases with the age and entering late, your risk increases is the biggest risk. Realization, as you said, the awareness, one is awareness of maybe investments overall, that there is something known as mutual fund and stocks. I don't think that is the case now. Mutual fund CA campaign has helped us. But the awareness that starting late, the investment amount goes up, achieving the goal is tougher, and the risk is higher if something goes wrong, that goal will not be met. So, the big risk is one is starting late. That awareness is also not there.
Yeah, that's unfair.
That's the first risk we are carrying. Second is The risk is increasing with age, the quantum is increasing. So again, these are very basic things. We think it's so basic, but for a lay person, the understanding is not there. So starting early is the best way to negotiate the risk. He has to do that. He can take higher risk when he is investing for a longer time. Not knowing the risk, this risk of starting late is the first risk he's taking. Then is that equity risk and the portfolio risk and stuff that comes later on.
I'm sure a lot of them come, in desperation to fund managers that I need this much money in this
very
time.
Late, very late. Thankfully, there is always the EPF thing which is there, and mostly salaried class are wise enough to keep it. So at least that social security is there. But for say a person in business who is actually a risk taker and something goes really bad, very tough, very tough. And who will bear the load of this?
The family.
The generation to come. So you don't plan for your retirement properly. We don't say you're going to be in a bad state or distress or anything of that sort. But we say when you're 75, your kids will be around in the 40s. Now they are planning for their retirement. If you're not independent, then you are going to be a drag on their financial planning. Not that your existence is a drag on them or your health or see, retirement is not just about money. It's about the social and mental well-being which the family brings. So money just takes the financial security. But at 75, if you're not financially secure, your health or other expenses might drag your child's retirement planning. So this is also a risk of not understanding the impact on the second generation. And what is our primary cause of anything that we do is our family. So I think the impact of that is also what one needs to understand when he's investing.
Okay. Coming back to investor behavior, how can these investors actually build discipline so that they don't make emotional decisions during volatile periods in the market?
Very good question. See, when we interact with investors a lot of time and we ask them which sort of fund would you prefer, a fund which gives very good returns this year and may or may not deliver, but every 3 years it is the number one and then it really doesn't do so well. And this other fund is more consistent in terms of the CAGR. And we have seen the most successful fund in the industry. You pick up any fund, they are the ones which are more consistent. They are not the ones which do well once in a while and then they stay quiet. And again they do well and your SIP might do very well and stuff like that. Do only SIP in these funds, don't do lump sum. Those really don't work so well. The more consistent, may it be large cap or a small cap or a thematic. So it is the consistency of a fund. So what is the investor preferring in a fund? Consistency. Question is, does he have that in himself? You want a fund which is consistent, you need to have consistency in you also. The very basis of SIP creating wealth is what? Discipline. That this date, so much money will be invested in this fund, come what may, unless you don't stop the SIP. That will happen. It will happen whether the market is high or low, whether the sentiment is good or bad. That investment is going to happen. SIP has discipline ingrained in it. Does the investor have discipline ingrained in him? Again, as I said, what you behave or your behavior with investments reflects in your personal life also. In simple words, what is the definition of discipline? The army definition of discipline? Doing things when you don't like them. That is discipline. Like consistency is, say someone says, I'll give Maharashtra example. I eat, say, 2 vada pav for breakfast every day. You will eat 3 also. So consistency is this, that I have this vada pav every day. So just consistency is not sufficient. I'll wake up at 6 in the morning and run 5 kilometers, whether it is such nice cold weather or whether it's hot weather or raining. I am going to run 5 kilometers every day. In winter you want to sleep, but you go and you run. That is discipline. So consistency is that repetition, doing things regularly, but doing things when you don't like them is discipline. When do you not like your SIP? When the markets fall.
When the markets are falling, yes.
When do you stop your SIPs? When the markets fall. So the very simple thing is, if you understand the importance of discipline in your life, you might not be able to do it. SIP has consistency and discipline ingrained in it.
Yeah, right.
The only, who really comes in between this consistency and discipline of SIP? The investor.
Yeah.
So SIP is a disciplined product. It has discipline ingrained in that. A lot of times we see in life also, we see a person who is very talented and along with a person who is moderately talented. 5, 10, 15 years down the line, it happens in career a lot. You see that this person has gone really very ahead in life, and this person is so talented, he's just not able to make it for whatever reasons, not having the opportunities or not able to break through. Very talented, just not disciplined. We see it in cricket, we see it in movies. We can keep on going on and on and on. People who are consistent and disciplined will do well in the long term. Why? Because they are putting efforts even during the bad times. A movie star goes through a bad patch, stops working, puts on weight, he's not going to get roles later. A movie star is going through a bad patch, he's going bankrupt and stuff, but he's very disciplined. He's reporting to the sets at 7 a.m. and giving those shots. The industry would want to work with that person. When his stars change or his times change and the good days come, he will be back in action. So discipline is very important. Mutual fund is offering to you on a platter through SIP. What you have to do is, as they say in yoga, Sakshi Bhavana, just watch it. Don't interfere in it. It has discipline. So this limitation that an investor is not disciplined is taken care by SIP. Just don't come in between that thing. Let it do its work. That is the best way to overcome the discipline of investor. Lack of discipline of investor.
Discipline in life and discipline while investing.
If you don't have, SIP has it. Let it do its work.
Okay, another part of this discipline is asset allocation.
True.
Okay, so investors who stick to their allocation seem to ride volatility much better than those who react daily.
Absolutely.
So why is sticking to a long-term asset allocation plan better than reacting to daily market movements?
Very good question. We have to understand first of all the purpose of asset allocation and what is asset allocation also. When you are putting money in assets which are, I won't say inversely related, but most of the times they operate inversely. Say equity and gold. History shows they are 70% of the time inversely proportional. What happens is by putting two negatively correlated asset classes reduces the volatility of the folio. The biggest reason why people are staying away from markets is what? Volatility. So the biggest problem is overcome by doing asset allocation. Rather, why SIP is so popular? SIP is the only product that benefits by volatility. So volatility, which is your biggest enemy for lump sum, is your best friend when it comes to SIP. So people understand this. They might not articulate it. They understand it that volatile hai to bhi eventually अच्छा पैसा बन जाता है. They keep on adding more and more money to their SIPs. So it is the experience that volatility helps SIP. Similarly, asset allocation helps in reducing volatility. In past 5 years, and what we were discussing before, post-COVID, SIP and asset allocation products have gone through the roof. So what the investor is telling repeatedly is this: give me a solution which helps me manage volatility. You can't eliminate. Market ka sthayi bhav, the very basic nature of market is it is volatile or asthir, chanchal, whatever you say. You can't eliminate it, you can manage it. Give me a solution which can manage volatility and beat inflation, my money is yours to manage. SIP is offering the same, asset allocation is offering the same. Both of them have this common feature, the ability to manage volatility and yet beat inflation. There is no guarantee on both the sides. It is just that they will be able to do it. That ability to do it is what people are perfectly fine with. And look at the SIP book and look at the sort of money we have seen in multi-asset and balanced advantage funds. So asset allocation helps in reducing the volatility. You can do it yourself, but how will you time it? And if you can do it, you're God. Hence, you outsource it to the mutual fund, to a mutual fund product. So there are there are multiple surely hybrid products which are a combination of equity debt gold. The equity and debt, pure equity and debt would be an aggressive hybrid or a dynamic allocation fund or equity saving fund. It would be plain equity debt or equity debt arbitrage. Where as the market goes up, the equity allocation is reduced. If the market goes lower, the equity allocation is increased. You are good. Your losses are less. Multi-asset has really been has been the star in the past 3 years because gold and silver have done so well. So a product like balanced advantage funds or hybrid equity funds, aggressive hybrid funds or multi-asset funds keep on rotating the money between these asset classes. That is one advantage. So eventually your returns are also better. Because of the gold and the debt part, the volatility or the shock of equity correction is reduced. In our culture, I'm sure a lot of people still, when they wake up, they say, Karagre vaste Lakshmi. It means money stays on fingertips. So Lakshmi ji chanchal hai. But it also means these are the 5 fingers, you know. It keeps on shifting between 5 asset classes.
Yeah, right.
Fingertips only. But if you don't take it will slip very quickly. But if it has to stay with you also, it has to keep on changing the hands. पैसा जितना घूमता है बढ़ता है. Now multi-asset or hybrid funds allow this money to be rotated at least between these 3-4 asset classes. Yeah. Equity, debt, silver, gold, international equity. And because the money keeps on rotating, as per our philosophy, it really turns out to be a very good investment choice. Your experience is much better, as I said, no, ability to manage inflation, manage volatility and beat inflation. That is the key. You will see a SIP investor, someone gets 15, someone gets 18, someone gets 12. They still give you repeat business. Are returns the same for them? No. It is this experience that volatility is managed and eventually my returns are good enough and they keep on coming back.
Yeah, you're right, actually. Rebalancing is the key.
Yeah, the thing is, see, rebalance, if you do it yourself, individually, sorry, I forgot on that part. If you do it yourself, one is, can you do it? Can your advisor also do it, you know, correctly? Tough. Second aspect, not many people will keep in mind is the taxation part. Because you'll be redeeming the folio and reinvesting, so you'll be taxed again and again. In a hybrid fund or a multi-asset fund, this taxation angle is not there. The money keeps on rotating in the asset class. There is no taxation for you. Or for that matter, even fund of funds now. Yes. So the money will rotate between funds and the taxation is not applicable to you. So the taxation part and the outsourcing part, both, so I mean, पांचों उंगली घी में आपकी, if you are putting money into, you know, these auto asset allocation funds, as to say, multi-asset or balanced advantage funds.
So I'll take this conversation a little further. Like you said, many investors can't do this alone and they need guidance. What role can a financial advisor actually play in preventing panic-driven decisions?
Well, an advisor only told me, so these are not my words. Surely these are words from Lord Krishna. And I asked him, you know, what is the role of an advisor? And he said, Krishna is the best advisor we have ever had in our history. And in one of the questions during the Bhagavad Gita, Arjuna asked Krishna a very simple question. They are friends. He says, how come you know all these things and I don't know? तुमको कैसे पता? मुझको नहीं पता. We have grown together. ये सब ज्ञान तुमको कैसे मिल गया? How come I don't know these things and you know? It's a very simple question that he asked. How come you know all these questions, all this stuff, and I don't know when we have grown together? And I think the shlok, if I'm not wrong, is Bahunemi Vetitani Charjuna Tanyam Veda Parantapa. I hope I'm not wrong. He says, Arjun, you and me have taken this janam again and again and again and again. You have forgotten, I remember. So what role an advisor plays is, this market bull bear. Say someone became an advisor in 91, has seen it maybe 6-7 times. Yeah. Someone started in 2006, has seen it 4 times. Yeah. Someone started in 15, has seen it 3 times. Yeah. Someone started in COVID, has seen it twice. Yeah. But an investor who is coming today has not seen it ever.
Yeah, that's true.
So these cycles of market and staying stable during those times is what an advisor will do really. The real value add is managing his behavior. This panic is a behavior.
Yeah, right.
Market is volatile, investor's mind is volatile, never really ever benefit. Yeah. So his mind is volatile, can be kept stable only by a guide standing behind him that don't panic. I have seen this happen again and again and again, and I have seen what it leads to. So trust me, stay stable. Yeah. That is the role an advisor can play and overcome this very common feature of getting into panic, and that's what a lot of direct investors do. Yes. And we see direct investors stopping SIP, the percentage is very high compared to those who go through distributors.
That's true.
Yes, that is the role. The wealth creation, again, is a different function altogether, but overcoming this behavioral bias, an advisor really can do a good role.
Okay. So every expert says, think long term and be patient. We have discussed this today as well. So in your view, why is having a long-term perspective the strongest defense against short-term volatility?
As I said, wealth creation really happens in long term. Yeah. I'll give you a very simple example of what we discussed earlier. Say the same example of SIP, 13.5%. I do a 10,000 rupee SIP. In 5 years, I'll invest 6 lakhs. The value is close to 8.3. So 8 lakh mein kya hoga? In 10 years, it's 24 lakhs, 24 lakhs. It's a decent amount of money. In 15 years, it will be around 50 to 53 lakhs. In 20 years, it's around a CR. So what is happening is, look at the power of compounding. A 10,000 rupee SIP in 20 years at 13.5 gave you 1 CR. This same 10,000 rupee SIP in 10 years is giving you how much? Say 24 lakhs. Say you want to retire in 10 years and you want 1 CR. Your 10,000 is becoming say 24.
Yeah.
Your goal is 4 times.
Yes,
Your SIP also will have to be 4 times.
exactly.
Now what is easier? A 10,000 rupee SIP for 20 years or a 40,000 SIP for 10 years? When you give longer time, your SIP or the investment amount reduces. It will be much easier to manage. Say at 40, a 10K is easier to manage if you are retiring at 60. At 50, only 10 years left into the job. Now you have to pay 40K every month. Now someone might say, no, I have a loan and stuff. At 50, my salary will be 5 times what I'm earning, and 40 is still okay for me then. Fair enough. Perfectly fine. So what they say is, what the biggest risk, whatever risk we discuss, the biggest risk is not knowing what you're doing. If you know this, that at this rate, my money quadruples in 20 years, it doubles in 10 years, and this is the input amount I have to give. That's perfectly fine. Even 10 years is a long time. 20 is surely very long, but 10 years is also a long time. If you are aware of this and then accordingly you are acting, you are home. But if you are not aware of this and at 50 you wake up and say, I need 1 CR, and you say, no, 40 is not possible for me, you are out of the game. So it's perfectly fine. Now just look at the same calculation. In 5 years, I'll get 8 lakhs from a 6 lakh investment. I need 1 CR. It has to go up 12 times.
Yes.
Next to impossible. I mean, for most people. So that's why long term works. The compounding rupee costing makes life very easy if you're able to give it longer time. That's why most people say start early and just keep it on for long term. Like 10,000 is still a decent amount. Even with say something low as 2,000, but if you give it 30 years, you can still get almost similar substantial amount of money for yourself. And 2,000, not a very big amount right now. But just having the trigger of starting the SIP and keeping out for 30 years. You know what is the biggest limitation we have? Giving an end date to the SIP. So you just wanted to try SIP and you put in say whatever 2,000, 3,000 and you said let me try for 3 years. And it did very well after 3 years also, gave a good return. The chances that you are going to restart the SIP is very low. It just doesn't stay in your mind. So you realize it on the 3rd year, say you didn't look at it, it's completed and there are 10 things to do, you forget it. So simple is start an SIP for a long term. In case it doesn't work for you, you can always stop it. You know, that understanding also at times is missing, that you can stop the SIP anytime, you can redeem the money anytime. So giving it a shorter end date also might be a very simple thing, which might be stopping you from creating that long-term wealth. So you see, it's just ticking that 3 year on the form or the app that might prevent you from creating long-term wealth. Put a 30-year tick, stop it whenever you want.
Okay. So before we wrap up, I want to touch upon these, which are the most practical tools investors use, SIPs and STPs. So in uncertain markets, they seem to offer huge behavioral advantages. So finally, how can SIPs and STPs help investors stay disciplined during volatile phases?
I think, I said the 2 pillars on which SIP works is rupee cost and compounding, and the 2 features on which it stands is, as we just discussed, is consistency and discipline. It's an inbuilt inherent feature. The purposes are different for both. Say someone says, I want 1 CR. After 20 years, we just discussed, do a 10K SIP, you might get that. But if you have 50 lakhs with you, just put it, maybe in a deposit, it will double in 10 years. SIP is for those who want to achieve a goal, but they don't have that much of money to put lump sum right now. For that goal planning, long-term goal planning, SIP is a good tool. STP is where you put your money in a liquid or a debt fund and then switch the money regularly to an equity fund that you want to switch to. Typically, people do it for shorter versions. You can do it for long term also, it plays out very nicely. But see, you have an X amount, say 50 lakhs, and you feel the markets are volatile and the geopolitics is working out and stuff like that. And I'm not very sure how the markets are going to be for the next 2 years. But I'm here for next 10 years and I have this money with me. Then we say put your money into an STP, and if you feel there is risk in the short term, do a 6 month. You feel it's a medium-term risk, do it for 2 years. And someone who's super cautious, do it for 10 years. The advantage is your money, the interest accumulates in your debt fund. So your overall investment, eventual investment will be much higher than whatever the 50 lakhs that you're putting over here. So you'll end up investing much more, and the compounding will work on that much more that you have invested. So maybe you might end up earning 60, 70 lakhs if you look at a 10-year STP, and the compounding will work on that money. So your experience and your results might be much better. So STP and SIP, both are doing the same thing. But STP is for someone who's holding a good amount of money right now, and wants to spread his risk in simple terms. Short term or medium term is really up to him.
Well, this has been really insightful. Thank you for joining us today. It was great having you on the show today.
Thank you so much. Really nice talking to you.
Thank you. Market volatility is unavoidable, but investor mistakes are avoidable. In today's episode, we learn how to stay calm, patient, and wealth-focused in volatile markets. Keep watching this space for more such powerful conversations. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.